Pardon?
It's good to see a different host today.
Yeah, okay. Thank you. Try my best, you know.
A new host.
Yeah, we did made some shift. Yeah, we changed because the two guys of Humor, they have like an upcoming meeting, the weekly. They shifted to today because yesterday has been Labor Day in the US. And, yeah.
Yep. Cool.
Yeah, I look for the chat. Yeah. See if there's somebody's on YouTube too. No. So, and OX Minion, he has also colluding meeting, so he will join some, yeah, he will join later, I guess. So we need to be like now 9.
Okay.
Yeah, we still miss some. I just write the Telegram again. Hi, Chris. So, hi, nice to see you. Yeah, okay. Yeah, we miss Jakes. Yeah, he is. vfat. Yeah, we wait another 1 or 2 minutes. Then I make the introduction. And, yeah. Yeah, Chris and Nick, they will leave. Yeah, they only stay for half an hour. So they go first and then they leave for their meeting. So we have like a. Okay.
Okay, Brian is joining.
Brian is joining. Okay. Yeah, we missed like Jason.
He said he can't find the DAO.
Oh,
He can't find.
I'm in the meeting room now.
Ah, okay. I saw. Yeah, true. You're here. You know, I miss Jakes. I think he was in the call yesterday.
Just Brian Lee now, right?
Pardon?
Just Brian Lee.
Brian Lee and I know the JX. I don't know his name. Is he on the call? No, he's not. Brian is in the process of joining right now.
He said he can't. He needs the URL. He said he can't dial in with the Zoom ID for some reason. He wants the Zoom link.
Ah, okay. He doesn't have the client.
Let me find out.
Yeah. Okay.
I put the link in our chat if that's easier.
Yeah, that's nice. Thank you.
So why don't we get started? I'm trying to figure out the link and I'll send to Brian.
Yeah. Okay, now, you know, we have like our internal chat, Cody is joining now, he writes. Fine. Okay. Yeah, because he hasn't been on the call yesterday, it would be maybe for him important to, yeah, we recap what we, not what we did talk yesterday, but I would just give a short introduction how the call should work, and then, yeah, we start off. Okay. Wow.
Sorry, it's my dog.
You have a dog. Okay, nice. Now. Okay, you made it. Hi, Brian.
Hello.
Nice
Hey
to
guys.
meet you. Hi.
Nice
to meet you. Yeah. Okay. So I guess what one we miss Jake's, I guess, but we start. He have been on the call yesterday, so he had like a short intro. So I'm Martin Krung. I'm hosting this call, and the purpose of this call is that every candidate is like the possibility or the should make an introduction to a project he likes, and the main idea is that we see which kind of expertise this person has, because this is also the reason why I made this forum post, and I was thinking that for most people it's more easy to see who somebody is on an example, and yeah, this is the purpose for this call. The format is that everyone has like 5 minutes to make the presentation, and then we may discuss or ask questions about the project. And as we, the team, we are the team Future Alpha, as we, the team, are on this call, so I guess we just ask each other about this project and background. And of course, we'll hear different things, and maybe I will ask some silly questions just to make it maybe more understandable for the audience, because we are all like DeFi pros, and maybe some of the viewers are not. So yeah. And then of course everyone is welcome to ask. You can also write in the chat, and I will ask if you have like an idea or question during the presentation, then I will ask it, or you can add additions and so on. And I will try the timing to have the time relatively strict. I have a clock with 5 minutes on it, and then maybe if I see you really running out of time, I tell you, maybe you have 1 minute to go or half a minute to go, and then to keep it short. As said, OX Minion will start later. Yesterday we had like a pre-call, and we agreed that I would like to show people their face if they talk. And if you're unknown, then it's okay to be unknown and not show your face, but I guess it's more easy for communication for us. And what's left? What's left is that if you speak about project, I think it's important that you like a disclaimer that you say what's your involvement with this project. So if you're an investor, you're close, that you tell this to the public. I think it's just fair. I guess most of us are not, but if you have like, just to be transparent, if you're an investor, that you just tell it to the public. So I guess Nick or Nick, you want to start, or Chris, or?
Sure, I'll start.
Let me share my screen.
Yes, please. The timer. Oh.
Oops. Okay. Is it
Yeah.
Am I
Okay,
okay? Cool.
Yeah. Thanks.
Yeah. So I will just walk through how I think about fixed income, which I think fixed income products are pretty interesting and will get bigger in DeFi. And I think that any savvy DeFi investor will eventually just need to figure out how to think about fixed income. So I'll just walk through a couple scenarios and how you can look at the current rates on Element.fi and figure out maybe how you want to invest or hedge your portfolio. So Element protocol allows you to take a vault token. So say you have like a Curve LP token or a Uniswap LP token or a Yearn vault token, and it allows you to deposit this into Element protocol, and it mints you a principal token and a yield token. The principal token is redeemable for the underlying. So usually the principal token is sold at some sort of discount, and when you buy it, you earn a fixed rate. And the yield token earns, its value is pegged to how much yield it actually accrues. So the core idea of Element protocols is it allows you to swap between principal or fixed income and variable income. So this is a screenshot of today's current rates. You'll see that there are 6 different Yearn vaults, and each of those vault tokens can be deposited into Element and allow the depositor to mint a principal token and the yield token. So the current prices of those are shown in the 6th column under price. You'll notice that all the principal tokens trade under $1, and all the yield tokens, you can think of that as the percent that the market thinks that the yield token is yielding over the term. So let's walk through one scenario. So say scenario 1, I'm an investor and I believe DeFi interest rates will decrease over the term. These are mostly 90-day terms. If I think interest rates will come down, I might want to lock in a fixed income rate. So what I could do is I could swap my vault token for the principal token. If you recall, the principal tokens all redeem for 1 vault token. So say you buy the Curve step token for 99 or 0.9914, you will earn 0.0086 of the vault token over the term, and that translates to some fixed APR. Scenario 2, say I'm still happy to lock in fixed rates, but I want to make a relative valuation play. Say if the Yearn vault is yielding lower than the fixed income I can lock in today, then I'm happy to take on the fixed income. But if the vault APY or the prevailing opportunity cost of the vault tokens is actually higher than the fixed income I can lock in today, I'm not going to make that trade. So this scenario for the investor only differs in that you need to consider what the opportunity cost is for locking in fixed income. So you could look at the vault APY column, or you could think about other external opportunities. If you look at the last row, there's a Try Crypto token, which the vault APY is around 27%, but on other yield aggregators like Convex and Badger, the yield's actually much higher. So this isn't as attractive as it looks. And lastly, if I have an opposite view on interest rates and I think that interest rates will increase over a period, I can actually swap my vault tokens for the yield token and earn and speculate on the yield. I can also compound. I can compound yield by selling principal tokens for more yield tokens and just increasing my yield exposure. So the really quick examples in the top row, if the yield token's trading at 0.0184 and the term is 90 days, the approximate APR is just the yield token price times 4. So that's the yield token right now is implying a yield of 7.36%. And if I think that yield is low and will come up in the next 90 days, I might leverage by that. And so besides the fact that you can use these tokens to hedge your portfolio and just generally earn yield, or maybe you need to hit, if you're a fund manager, you need to hit like certain thresholds, it's an interesting way to do that. I also think that the fixed income market's going to be really big, and Element.fi has, I guess, a good start in the space. It's a brand new space, and I also experiment in the protocol because I'm speculating on earning future rewards or future equity in the protocol. And I am not an investor in Element.fi.
Okay, thanks. Yeah, you kept the 5 minutes sharp.
Nice.
Or you finished, I guess. Yeah.
Great.
Yeah, are there any questions?
I have one. Like, why would the fixed yield ever be higher than the floating yield, like in the CRV STE? Like, what market conditions created that price difference like that?
That's because the Yearn vault is not actually yielding as high as Convex's vault. So Convex's vault is closer to 8%.
Interesting.
I only know like Bound protocol because there's like, yeah, this is the same, I guess, or is it different? No, Bound bridge is it called?
It's pretty similar, I would say. It's a way to like slice investments into different tranches.
Yeah. I guess maybe it's different because there you just give in dollar or the stable coin, and then they do it in the background for you, I guess. I don't think you provide like, here you have to provide your liquidity token, I guess. You provide your liquidity token.
You don't have to. So I guess what you could do here is like the way you locked in fixed interest rate is different. On Element.fi, you buy principal tokens at a discount and you earn that fixed yield automatically. Whereas Barnbridge, you invest in their vault and they guarantee the fixed income investors some yield. And so they pay them back first, and then any excess yield is paid to the other people.
Okay.
So I would say Barnbridge is a bit riskier than this.
Do they have a token element, or is it how is
Element?
Yeah.
They don't have a token, but they raised a lot of money, so I imagine they're going to decentralize their governance at some point.
Okay.
How is it different from Pendle and their approach?
I don't think it's different from Pendle, but I think Pendle has liquidity mining right now. So an interesting thing to track is usage of the two protocols, and if Element can meaningfully distinguish itself from Pendle without liquidity mining, it's more attractive.
Got it.
Okay. Is it all mainnet? You know,
it's all mainnet.
Just
yeah.
Okay. Yeah.
Yeah.
Yeah. Of course, you know you have to.
Yeah, they got like what, like I don't know, 30 million locked right now, mostly in the principal pools. The yield tokens are just riskier, and I think people don't fully understand them.
Yeah, I personally, I don't. Yeah, it's an area I don't know much. You know, just that. Yeah. But the maximum you can get the fixed API is like these 90 days or 180 days. This is the maximum. Yeah.
Yeah, the 180 days is the longest one, but theoretically you could use this to make like 5-year bonds or 10 years.
And how do you get the RPR? Like, you know, what do you get back?
So say row 2, look at row 2. You can buy that principal token for 0.9636.
Okay.
So you trade one Curve LUSD vault token for 0.9636 principal tokens, and that expires to 1. So you earn that spread.
Yeah. Okay. Okay. Yeah. Thanks. I know. Other question? Well, I have a more personal question. Why are you interested into this? Do you have a background? Like the traditional finance in this, or?
I used to trade bonds at Barclays, but also I think fixed income the fixed income market is much larger than the equity market. So at some point, this probably will happen in DeFi. And right now, there's really no good fixed income markets in DeFi.
Okay, thanks. I think that's it. Thank you very much.
Cool.
So I
Thank you.
guess next is Chris.
Cool. I'll share my screen. Okay. Can you see my screen?
Yep.
Cool. So I'm going to talk about.
Cool.
Sorry, my console opened. I'm going to talk about one of BondBridge's new products. See, we mentioned them earlier on. So BondBridge has been around for a while, but they're launching this thing called Smart Alpha Bonds, which I wanted to talk about. And I want to look at like the overview of the project, the risks that it holds, and maybe some of the opportunities that an investment DAO could use when considering this kind of asset. So BondBridge really aims to tokenize risk within different protocols, and it aims to sort of reduce risk in different protocols by tokenizing certain cash flows and using this to actually hedge certain elements within risk profiles. So the way they do this is through like liquidity tranches, and we'll get into what that means in a little bit. The two products that BondBridge has right now is sheesh, sorry, I'm struggling with my slides here. Yeah, so Smart Yield and Smart Exposure are the two that they've had that's out right now, and Smart Alpha is the new product which is being launched now, which we'll talk about. So they were launched in 2020, October 2020, and the Smart Yield product, which has been running for a while, basically enables you to access multiple different stablecoin yields through different lending markets. And the idea is to be able to offer different risk profiles for different investors, depending on what your tolerance for risk is. And the Smart Exposure, basically, the product offers you the ability to maintain a specific ratio of two underlying ERC20s. And this can be quite interesting for different kinds of risk-adjusted retargeting strategies. So maybe you want to hold like 50-50 DPI and ETH and want it to rebalance between these two. So we're not really going to talk about these. What we're going to talk about is Smart Alpha. And the reason I'm interested in this and wanted to research it is that it's coming out next week, Monday, and I thought it could be quite a cool product. So basic idea is to build risk mitigation strategies using volatility derivatives. So the way that they do this is they basically create this notion of like risk ramps, and using this, they create two different tranches in like the simple case. So you have like a high risk, high reward tranche, and that will offset a low risk, low reward tranche. So basically you create a product that offers different kinds of risk profiles to different users, depending on what their risk tolerance is. And then around that, you can structure different kinds of payouts. So in this simple case, we're only considering a high risk, high reward, low risk, low reward, but you can also create like n number of different tranches in between that have different kinds of risk characteristics. So a basic example would be like if we created a product that tracks the price of ETH, and this thing starts at trading at $1,000 and then moves down to $900. The riskiest tranche would take a much higher loss, and then the low risk tranche would take a lower loss. And the inverse would obviously happen in the other direction. Whereas if the price went up, the high risk tranche gains more than the low risk tranche gains. And the cool thing about this is it's all done algorithmically, obviously using smart contracts. And this enables us to actually build quite interesting curves and different like market structures that today isn't really possible. And we'll get into some of the cool things that you can do with that in a little bit. And what's nice is each of these different tranches can be tokenized separately. And I think the composability that we get from building out like layering of tranches and using tranches within other projects hasn't really been explored in any other project yet. So this is just like a very simple example where we can get kind of visualize what the previous slide spoke about. So with the, a small, pretty large market downturn, you can see the senior tranche, which is the low risk tranche, has like a smaller price impact than what the junior high risk tranche would have, obviously. And the inverse is true in the market rallies, like number go up more for the high risk tranche, number go up less for the low risk tranche. And really what the opportunity for this is and why this might be interesting for someone like an investment DAO or like an individual investor is firstly, you can access like higher exposure with less capital by buying the high risk tranches. So this effectively enables you to lever up. But the nice thing is that this is kind of different to leverage in other senses, right? So there's no risk of liquidation, and there isn't like a lot of the complexity that other leveraging mechanisms might have. So we don't need to consider like funding rates. We don't need to consider, like maintaining margin and all this kind of stuff. But obviously there is going to be some complexity in the sense that we don't really know how the pricing of this thing is going to work out. So there might be some second order effects that we see that kind of only going to see once the market evolves. So that would be like the use case of the high risk tranches. The low risk tranches, you could see this as like a profit taking mechanism where you take profit with dampened exposure to lower your actual risk. And we're going to have to see what happens with liquidity mining. They'll likely have liquidity mining when they launch. And then the risks associated with this are mainly going to be around the fact that this is completely novel and hasn't been tested in the wild. So we're going to have to see how that plays out. But I think it's a very interesting mechanism that definitely should be explored. And the complexity and the novelty of this means that there's likely to be mispricing, which is both a bad and a good thing. If there's mispricing, there could be opportunities they can take advantage of. And last 2 points would be that until it grows, liquidity is going to be poor. So actually accessing this in any kind of size is going to be difficult. And they haven't actually publicized their smart contracts. So I wanted to go and read them and see what's going on under the hood, but didn't get to see that. And yeah, there's no information on the auditing yet. So yeah, that's basically the smart alpha product from BondBridge, and I think it's quite an interesting concept.
Yeah, thank you. I do these instruments. Can I, if I invest into this, do they have like a time? Is it the same as the other products we saw before? You have a timing of 90 days and then it's over. It runs forever. Or?
From my understanding, and I might be wrong, from what I read about it, there's no expiration timestamp. It runs into perpetuity. But that could be wrong. So I'm not exactly sure, but I think that's the case.
Other questions? I look in the chat.
Where does the yield come from?
The yield?
Yeah, where does like BondBridge invest this stuff?
Well, it's not necessarily yield in any traditional sense, right? It's like levered exposure on the underlying. So you can think of it as like the high risk tranches just get like a multiple on the ETH payout, whereas the lower risk tranches just get like a dampened payout. And I think like the dampened payout could be very interesting for use as collateral in other products, especially if you're creating like stable coins. Where you can kind of get like a dampening effect on like a potentially very high risk asset, which could be interesting. But yeah, there isn't like a traditional notion of yield past this.
Yeah, it could be also a product for like treasury management. You know, we had like in the other DAO, the DAO we had quite a large treasury and it was not so easy to manage it, or we didn't want to manage it in a way, or the associated risk is, yeah. And I think maybe it's also a product for that, for this kind of people, because then you need the money for running costs in a way, and you don't want to go in too much into the risk. So now the reason the DAO then we sold a part of the ETH to get some stable coins because of this, the end. And maybe this is not, could be a product for this too.
Yeah, for sure. So I mean, if people want to speculate on your DAO token, you could provide that as liquidity in the low risk tranche, and then people will be buying the high risk against that to speculate with leverage. And I think also there's a simulator that they released, which you can see like the impact of leverage as the price moves. And I think what we'll see on this, based off my preliminary reading, is that you'll be able to access higher levels of leverage than you would in other kinds of tokenized leverage positions. So like, there's like some products that are like tokenized 2x ETH exposure and things like that, but there aren't like tokenized versions that go up more than 2x. So like if you want more than that kind of leverage, then you need to go on to DYDX or like a KYC account on FTX, something like this. Whereas I think that this kind of product, by very nature of how the tranches are structured, could reach much higher kinds of leverage. So yeah, there definitely will be some interesting dynamics around that, and a lot of stuff that DAOs can do.
But every time you need somebody taking the other side, so it's not pooled. It's not like an Insta market. You don't have the liquidity in a way. They have to build it somehow. Because if nobody is on the other side, then it's not working.
Yeah.
Okay.
So I mean,
this maybe
it's well. Then, right? If your DAO has a lot of tokens that they don't want to take high risk on, but it remains to be seen how well it'll work for products like ETH, right? Like if people don't want to take the low risk tranche. So yeah, I mean, a lot of the information here is just based off of reading their docs and like trying to understand the product, because they literally haven't launched yet. But yeah, I just use this as an excuse to research it more than anything.
Yeah, that's cool. You know, it's nice that they make a simulator somehow, because I think now on mainnet, you know, years ago you could just test it out, but now transactions are so expensive sometimes that it's not easy to test the stuff. And if they make some kind of simulation, it's maybe almost the same. You know, they also
Absolutely, yeah.
could do it on a like a cheap chain or something like this. Okay, thank you. Yeah, thank you for joining. I think now you have to leave for your weekly coordination call, and yeah, nice having you. So
Thank you,
I
guys.
think
Thank you.
yeah, cheers.
Thank you, guys.
Ciao. Thank you.
Cheers.
Interesting project. Yeah. So I guess the next, Cody, you go next. Are you ready?
Sure. Yep.
Yeah.
Ready to go.
Cool.
All right. Let me get this up here. All right. Can you see that okay, or did that not share yet?
No.
Let me see. Sorry, there we go. Just make sure that presents okay. How about now?
Yes.
Okay,
It's on.
cool.
Thanks.
All right, so I'm Cody. I'm a trader at CMS Holdings. Just super quick and dirty background, just because I wasn't on some of the previous stuff, so people may not know me as well. Like I said,
cool.
right now I'm a trader at CMS. Previously was a trader at Circle OTC. I've been professionally in crypto trading since beginning of 2018, and more of in a personal capacity since 2016, 2015 area. So the project I'm taking a look at today is Alchemix. And just quick little disclosure, CMS is an investor. This is just really for demonstration, not financial advice, all that stuff. So essentially, Alchemix is a synthetic future yield-back asset platform. And so that's kind of like a lot of words, but it allows you to deposit assets and mint debt against it. That's essentially an advance on the yield you would get from the deposits. So instead of just putting it into a normal sort of debt protocol like Compound or Aave and getting your yield slowly, it kind of allows you to withdraw that yield ahead of time backed by your collateral. And the yield on that collateral pays back that debt over time. And since the debt is always being paid down, and with the current design, you don't have to worry about liquidation, which is a pretty handy concept with like sort of any kind of collateralized debt. So one of the major components here is called vaults. It's basically the center of the protocol. That's where you deposit the assets and you mint the debt against it. Right now there's DAI and ETH, which allows you to mint AL USD or AL ETH, which those are basically the synthetic assets that you mint as debt. See the borrow limits are a little bit lower for ETH there, just because of obviously that's not a stable asset like DAI. The collateral then is deposited into urine vaults to get yield. And again, like I said, the yield is automatically paid down over time. So you can either owe less of that debt back whenever you want to close everything down, or you can borrow more as you go along if you want to keep that open. If you want to close everything down and just keep it super simple, you can liquidate your collateral. There's a screen basically right on the platform that you can use the collateral that you deposited, liquidate that, repay the debt, and anything over that debt basically is returned back to you. And so what this basically gives you is a flexible line of credit on your yield, and you can take that really however you want and get yield across the ecosystem however you see fit, though there are a couple of ways directly on the platform that are pretty lucrative. The second major piece is the transmuter, which basically is how the synthetic assets stay pegged. And you can always swap ALUSD for DAI or AL ETH for ETH 1-to-1. So this essentially makes it so that, you know, if there were market prices that deviate over on, say, like Curve or wherever else some of these are trading, if they fall below a peg, there's arbitrage opportunity for anyone to come in and close that down. So that sort of keeps the peg right on. And then this transmuter also deploys its capital into urine vaults, and that boosts the yield for the depositors in the vaults. So a lot of times, like, you'll see the yield is quite a bit higher on the vaults than directly going into the urine vaults themselves. From there, you can do a lot of things with the debt. Like I said, you can really do anything, but if you want to keep it on platform, there are some pretty lucrative farms directly on there. Curve pools, saddle pools, etc. There's some LP pools on Sushi, on MStable. They're just that have rewards of their own. Or like I said, you could trade the synthetic assets. There's the curve pools and saddle pools that allow you to go from DAI to a bunch of other stable coins, or from AL ETH to wrapped ETH, and then you can take that and farm wherever you want. And just I just want to quickly note on APY, just so people kind of get an idea on these things. There's a lot of assumptions that are made when you see a big APY number on a screen. The price of the reward token, what the emission is, the total value in the pool, how they're compounding. And so that can change a lot depending on the price of the token, the total value in there. The emission rates often scale down over time as the product kind of gains traction, that it'll naturally lower. And APR is the base rate before compounding. APY takes into account compounding. So you kind of have to make sure that that math is being done right as well. And everything's different there. Yeah, and just some risk disclosures. Obviously, you guys probably understand all this, but just to throw it in. I think I'm probably near the end there, so.
Yeah, cool. Thank you.
Yeah,
Yeah, I myself, I have some ALUSD, but I don't know what to do with it. I just put it in, took it out, and then yeah.
Yeah, I mean, you can take it
in
anywhere.
a way, you can go leverage. You can sell it again to DAI and do it again.
Yeah, absolutely. You could do the sort of leverage loop if you want to do that. There's also some pretty good rates on just depositing that into Curve or some of the other pools you can get right on the farming page on the platform. So, and then
I think it'll
pay back your
awesome.
debt there.
It's an awesome product in a way because it's just just turned around somehow.
Yeah, I think it's also obviously on the back end it's not so simple, but like for the end user it's honestly pretty simple to use, and for someone to kind of try out farming, it's not like super scary to get into, but you can make it more complex if you want to.
But you token, if you don't touch it, then you token you see, so it gets paid back, and then at some time you can like take out your DAI or ETH again. Yeah, that's basically exactly. It is. Yeah. But nobody knows how long it takes. It's just
Well, I mean, it's obviously it's going to vary depending on the rates in the market, and like right now, stablecoin rates are fairly high, but that fluctuates. I mean, in general in crypto, like stablecoin rates stay pretty elevated, just based on demand for leverage and a whole host of things.
Yeah, exactly.
So like it's a pretty good option for some decent yield on that stuff.
How long is the token? Now you get some Alchemix token too. Is it the government's token or what's?
Yeah, exactly. The rewards are in the Alchemix tokens, or at least a lot of the pools. And so that's basically the governance token of the platform that you can use to vote and that kind of thing. And there's pools for the Alchemix rewards that you get as well that are pretty high interest. So if you are sort of want to stay in that ecosystem and you like the token, you can get pretty good yield on that as well.
Okay, someone else?
Is there a reason why they only choose Earn when I think like Vesper or other yield aggregator has better yields?
Yeah, I think like, I mean, obviously I can't speak for the team exactly, but I think overall it's like it's obviously one of the big blue chips that people feel safer putting capital into. So, it's just probably more a function of that. I'm sure over time, like maybe they would expand as things, get more like field tested. But for now, obviously, Yearn is a pretty tested product, and people feel comfortable like deploying like a fairly large amount of funds there. So, you know what I mean? You may not want to sort of place your bets for an early protocol on something that is less tested. But again, it depends on risk profile. It depends on anything. Obviously, I think like token holders could vote to add some quote unquote riskier pools if they wanted to juice yields even more. But that's sort of where it's at right now.
What are their current kind of token utility for Alx?
I think mostly it's governance right now. Again, like any governance token, I think that can take any shape in the future depending on how the token holders in the DAO decide to take it. So
Understood. Are there any other? I guess there isn't any competitor similar to. I think it's one of the blue chip that no one actually forked, right?
yeah, I think they're trying to think. I thought I heard of something that did like fork it a little bit, but I can't remember the name right now. I mean, it's honestly it's pretty similar to a lot of other like collateralized debt platforms, but then you have sort of the self-paying debt aspect, and it definitely has some unique elements to it that I think make it pretty interesting.
Yeah, for sure. I always think that it would be interesting if they added, other asset when they. I think they have a little hiccup when they added ETH as collateral, but I think after that everything went well. It would be interesting if they add, like wrap Bitcoin and some other assets. Yeah.
Yeah, I'm sure all that stuff is definitely in the roadmap. They want to add more. It just, they want to make sure they do it well and make sure stuff is integrated properly and that like it's going to be popular enough. But I wouldn't be surprised at all to see like something like wrap Bitcoin in there at some point soon.
Yeah.
Well, I can't say soon. I'm not the one working on it, but you never know.
Yeah.
Awesome. Thanks.
No problem. Thanks for the questions.
Thank you. So yeah, myself, I'm next. Okay.
All right. Thanks, guys.
I have to switch my my mindset now. Just a moment. I'll share my screen. Yeah, for my timing. Do you see my screen?
Yep.
I guess so. Yeah. Yeah. I'm looking at quite a new protocol, and it's called Ricochet Exchange. It's a difficult word, I guess. And yeah, that's the oh sorry, skipped. This is their Twitter platform. They don't have a lot of followers right now, and I did choose this because I'm interested in somehow I'm interested in streaming value or token. Because for me, streaming is like I think it's a more natural form of money somehow. And money streaming is that in a way it's like a form of micropayment, but it's just you open like you say how much money is streamed over time, then you set your target, and then that's it basically. And I think if you look at the world, if you work as an example, you constantly give out like value. You add value to something, and you should in fact also receive the other side of the value as money. As yeah, normally you get it once a month, and I think it's much more natural to have this like a steady flow. And I also guess my take is maybe it was also allow other economies, because then otherwise the trust doesn't have to be so high, because now it's like an asynchronous system. Either you have to work and then you wait for your money to get paid, or you have to pay it in advance. And if it's like at the same time, then if you don't agree with the value created, or then you can just stop your stream somehow. And yeah, this is more speculative protocol. And I'm also interested in the dollar cost average, and I try to do this because if you do it as a person yourself, then it takes a lot of you have to think about it and you have to do it. And I think it's a bit awesome to have like a protocol who does dollar cost average. And the thing about dollar cost average is that you invest the same amount of money every day or every time period. And then if the asset is cheap, you buy a lot more. And if the asset is high, you buy more or less. And so you get a decent scaling in somehow. And I also think DCA is interesting for volatile assets and for low liquidity assets, because if asset is low liquid and you buy in, then you have a lot of slippage, and then normally you wait till it readjusts and then you buy again. And if you have like make DCA, then you don't have this problem. So, and this project is 1-2 months old or so. It's based on Superfluid, and Superfluid is a streaming protocol. And there's one streaming protocol was the first one. It was called Sablé. I did try it out, Sablé, like 1 year ago or 2 years ago. It was quite fresh, but Sablé is quite primitive. You can't stop streams. You can't open up your stream, and then Superfluid framework is much more advanced. So and they currently, the project itself, they do something I call flow mining. I don't know if this is the right name, but they give out distribution of the token if you use it. So if you use it for DCA, then they give you token. I don't have any connection. I know the guy as an investor or such, but I know one person of Superfluid, and so I came to this project too, and I've been using DCA. Oh, I'm too slow. So the app is very rough, it's very easy. It's very rough, it's a fresh project. The front end is not polished. And we'll go through the steps. You have just to wrap your ERC20 token, because it needs a special token. ERC77 is the token standard. And then you set your speed, and then it's like streaming. It's streaming, but in the background, like every 5 minutes, all the streams together are like buy the token, ETH token from Sushi, and then it goes like backwards to you, or the stream is like redirected to yourself, or however you name it. And because it's quite complex, it's not on mainnet. I don't know if Superfluid is even on mainnet. It's on Polygon only right now, and they need oracles. I think maybe there's some phone trunking, or just as a protection, because you buy like every 5 minutes, or you see if there's like this buy event, and maybe for the protection you need some oracles. And what interesting for me is that they do like distribute my time is over. Distribute the token during this process. I was quite a fan of this, but now I look a little bit close, and I'm not so sure if it's really a good product. The pros, I guess Stream is the future. It's very nice. The DCA is like very granular. Every 5 minutes, it has a token, and they distribute the token like this. They're quite open. They have a community. They have a solid background with Superfluid. You need less transaction yourself, because the rest is then done by them. But it's very early stage. And last week they had like an incident. They updated their software, like the running software, and the streaming of the token was already running. And they updated it, and people migrated the token to the new version. And then they just pointed somehow, the token pointed some stream to the void. So they lost a couple of $1,000. And but now as Superfluid, it was a hackathon event for Superfluid, and Superfluid is reimbursing the people. So it's very early stage. And they had like this incident. The communication was quite okay during this incident. They're reimbursing people. But that's at early stage. I don't know, but I really don't know. I know the DCA, I guess maybe it's just over the top. It's enough if you make buy event once a day, or maybe twice a day. You don't need like 5 minutes. So maybe it's just an overkill. And then you need like this special wrapping. You need to wrap it into this token. So And for myself as a user, it's not permissionless. What I would like is have a system where I can buy any like low liquidity token, which I think has some potential. But now, you know, you need like a SushiSwap pool. I guess they self like Ricochet exchange themselves, then they need to list it. You need an oracle for it. So it's also has quite some limitation. And what I found out today was that, you know, at the beginning of a thing, yeah, you need take part of this, you invest, DAI and buy ETH. But what I found out today was you can do it like crosswise, you know. You have one stream, of course you need capital, but you can have one stream who does DCA from DAI to ETH, and you do it the same time with the same amount of capital, the other way around. So you don't have any risk, but you can like farm the token or flow farm the token. So this maybe is, I think it's strange. You need the capital, but somehow you need to use the protocol, but you don't have the same risk. You don't have the market risk of it, but can get the token. Yeah. Sorry, I'm over time. That's my project. Any questions?
Yeah, I kind of have a quick question. Like, where do you see this sort of being like an immediate use case? Like, what could you use this for mainly right now?
I think DCA is underrated somehow. I don't know why it isn't more common also on exchanges. I think it's a for uninformed users, it's quite a good product.
Mm-hmm.
I guess it's not so. You know, I don't understand why I can't set up like a DCA on a centralized exchange. I know there are some, but it's not really common. And my take is, I guess exchanges want to get people trading, you know, and not like DCA into. I think it's quite a big market, but maybe it's not. You know, I'm not so sure.
I could see it like a DCA or like a TWAP style thing for like.
There are other projects work on this too. You know, it's just that, and I did read the white paper today, and what's interesting is that you really need less transaction. You know, if you have many people pooling this, then you do a transaction every 5 minutes. But I think it's too much. You don't need it, you know. But you can do less. And then for the buying transaction on the SushiSwap, you only need like one transaction. Of course, you get more slippage. You know, it's just maybe it's a trade-off.
Right.
Yeah, there are other trade-offs, and I think for me, I would really, you know, I see a lot of projects which I think, yeah, I would like to invest in this, but I don't, because it's just, should I invest just, I don't know, $500 and then forget it? So I would rather invest like $500 over a certain time than just as a one-time event. So yeah.
Have they raised any money?
Yeah, I don't know. You know, there are a hackathon from Superfluid. There's a page I did see yesterday on researching. People can like get like grants. So I don't know. Somehow they're quite connected, and they're not audited. But on the Discord, somebody asked this, and I asked them, and they told me, yeah, Superfluid is like reading the code. And as they had this bug, the bug was like, maybe it's hard to test because it's not so easy to set up in a testing environment, because even then they didn't know for 2 days why the bug happened. So this shows, I don't know, maybe the team is not mature enough, or the technology is hard to handle. I don't know. I don't think they raised money. It's just that the distribution of the token is 10% for this flow mining stuff and 10% for the team, and the rest is like for the DAO. But it's not public. It's what I did see, it's like closed. They have like, it's not open source project. They have like copyright on it. Yeah. Other questions? go next.
Thank you.
Yeah, welcome. Yeah, on the schedule it's a vfat. I heard he talks fast. Are you here?
Hello everyone. Yeah, just
Hi.
1 second.
Yeah.
Share my screen. You need to stop sharing yours.
Oh yes, yeah. Oh, it's like this. Last time at the same problem. I really. Yeah. Okay. Cool. Yeah. Sorry.
Okay,
Go ahead.
Share screen.
And you stay anonymous.
Is that showing? Yeah.
Cool. Yeah. You see it. Yeah.
Okay. So for my presentation, I'm going to focus on a more lower level of analyzing the contracts for a yield farm. And obviously, as it happens, a yield farm starting in just a couple of days is AladdinDAO itself. So say you've decided with your due diligence that you want to earn some ALD tokens in the fair launch part. So you want to analyze the contracts to see if they're safe. So the basic contract is a master chef. There's a few modifications, but nothing major. It's emitting 500 ALD per block at the start into 6 equal pools, out of which 2 of them are native token or death pools, I suppose, including ETH ALD and USDC ALD, as well as 4 Aladdin Vault token pools. The vaults being Curve 3 pool, Curve Seth, Curve Ren BTC, Sushi and Sushi F BTC SLP tokens. The 4 Vault tokens, the underlying curve pools are all very big, and the Sushi one as well. The TVLs are in the 400 million to 1 billion range. Whereas for the native tokens, because they have not been seeded, there's no money in them at the minute. Well, there's a little bit in a small test amount in the ETH ALD pool, and nothing yet in the USDC one. But some will probably be added by the team in the next couple of days before farming starts. So the contract itself, obviously the base contract of MasterChef has been proven safe, but we need to check for any differences. In particular, there are the right functions that affect user deposits, user funds. They are deposit, withdraw, emergency withdraw, and claim all. So going through and checking them one by one, you can see that they all use the message sender to do the operations. So there's no way for a contract owner or a third party to affect any user deposits. There's no risk at all there. As well as the rest of the functions involved, there's functions to add new pools, change some parameters, but there's no migrate function like there was in the original Sushi, which can be used to transfer user funds. There's no rescue function or anything like that. So if you send a token by mistake, it's going to stay there forever. But there's no risk as far as the MasterChef pools are concerned. Now, the Aladdin Vault tokens, they obviously carry smart contract risk themselves, because what happens is first you get the curve token, which obviously is a complicated smart contract itself, but it has been tested for quite some time, so we can assume that's safe. But then you have to deposit that into the AladdinDAO vault. Now the vault is controlled by the controller. The controller takes the funds from the vault and uses the strategies to see where it's going to deposit into farm, and then also from the strategies takes the profits and invest them. Finally, these are controlled by governance, so we've got 4 different contracts that we need to analyze here. And then, of course, if we pass over the underlying contracts, which is the curve ones. So after all that, get into the farm strategy. So the first two pools, the native token pools, are going to have crazy high API, of course, on day one, because it's just like sushi when that launched. There's no tokens around at the start, so the pools are going to be empty. So they're going to be paying a lot of tokens versus the amount of tokens in them, which means their price could go crazy high. And then, especially on day one, it is going to be incredibly high risk to invest. And then as the days go by, it should stabilize. The vault pools, on the other hand, you can pre-stake, which is good. So you can have your funds ready for when they start. The APIs will also be quite high, but there's hardly any risk because you're not worried about your funds changing in price. So a couple of possible strategies here. An active one would be to farm the vault pools, claim your ALD as soon as there's enough to not lose too much to gas, and then use it to provide liquidity, possibly by selling half in the two native pools, and then just continue compounding. Or a passive strategy could be to simply just farm on the vault pools and then just claim your ALD as you go whenever you want. And as a little bonus, then the vfat page for the above farm. That's it.
Thank you. You made a page yourself. Cool. Very nice.
Noise.
But you didn't, I did ask Sharlyn some time back. You didn't look at is there any like audit of these contracts?
Yes, I did look. There's two audits by Certic and Peck Shield, and they've both been acted on.
Because I like to read audits somehow. It's just that's what I do most. I don't be so active as a farmer. I like to read audits somehow. Yeah.
Normally, what I do is I look through them myself, and then when something comes up, I'll check the audit. Like on these ones, I saw that the fees can be set by governance, and I saw that there are checks so that the fees can't go over 100%, but they're still allowed to go up to 100%. This isn't a risk in the case of AladdinDAO because obviously it's controlled by the multisig, where you need 6 people to sign. So it's impossible to get 6 people to sign to make the fees 100%. But smart contract wise, it is possible. So then I had a look in the audits for this. And the audits did mention to put these fees minimum and maximum in a certain range, but they only mentioned to make sure they're under 100%, not to make them a bit more reasonable, like a maximum fee of 5% or something.
Okay, yeah, makes sense. Other questions?
Yeah, I think it's very good analysis. No wonder why vfat has been asking me questions about AladdinDAO today.
Yeah, exactly. Yeah. He asked me too. No, he asked in our chat if it's their mob. Yeah.
Yeah, he checked with our developer as well. So very comprehensive due diligence.
Cool. Yeah. I have a question. But if you do, I did farm, but I'm more like a pre-farmer somehow. I'm not farming actively anymore. But if you are in a pool 1, what's the strategy there to farm? You wait, you have like your capital and then you use it, and then do you look how the price changes, or do you have like a preset timing? You say if I have enough, if I've doubled or I have a target API of, I don't know, the first day of 10%, and then I'm going to de-risk and sell it off, or how do you calculate it, or do you do it just if you farm on your feelings? Or
yeah, it's hard to say. A lot of it is by feel. Yeah, it depends a lot on the liquidity, really. If it's a low liquidity, I will also only invest a little bit myself, and then increase or sell accordingly. I will always keep it as a small percentage of the pool.
Okay. But you don't calculate this. You just, you also could like make you can make like this cone of uncertainty. You can make a prediction of the price maybe 2 days later, and then you can calculate the impermanent loss you take, and then make a strategy out of this. I think there are people out there that are doing this like this. They analyze this and then they make much more. You sound like you do it more like you decide on the go. You see how it develops and then you react, but you don't have you don't calculate at the end.
No, I don't use price predictions. No.
Okay. Yeah, that's cool. Okay. Yeah, interesting. I was thinking like the pro farmers, they do, they have like a huge balance sheet somewhere where they calculate all the stuff, and then you could also like automate this somehow, then you don't have to decide yourself. Somebody. Yeah. Okay. Yeah, thank you.
Okay.
All the questions, upcoming questions. I look at the time. Yeah, I think we are quite into time. That's cool. So next would be Jason. Or I can pronounce your Chinese name.
Hi.
Hi.
Yes. So share my screen?
Yes. And your face too, if you would like to.
Thanks. Okay. Okay. So thanks everyone. So first of you, introduction of the team. So basically what we are doing now is we're developing some professional bots. I say professional because we're doing a lot of different trading bots, for example, like arbitrage bot across in different chains and DEX. And we also do some sandwich bot, NFT sweep bot. So like sniping all the NFT with lower than floor price. And other MEV bots we are doing. Besides these developments, we also do some consultant service. The topics including like MEV, DEX, security, mining. So this is our team currently doing right now. So next, I think today I try to show like a random side project we do. I think it's pretty much represents a typical workflow of our team. So this thing happens last week. So it's issue happened with Terra's breach on Ethereum mainnet. This issue is, however, is quickly fixed by Terra team. They respond very fast, and so we got this notified from an official Telegram group from Terra. So a few users claim they cannot transfer funds between Terra and Ethereum. So we quickly came to the Etherscan and checked the breach contract, and we do see a lot of failed transactions. So starting from like 3 days ago, and after that, all the transactions fail, keeps failing. So we start doing some analysis. So first, we're trying to understand what the logic of the contract. So this contract is a breach on the Ethereum side, so which allocates the tokens after the user burns it on the Terra side. So the Terra admin was signed with a multi-signature, and this contract will verify the signatures and release the fund. So we start by looking from the first transaction, which is failed. This one is caused by like ERC20 transfer fail, and then all the other transactions failed with like invalid signature, which sounds quite alarming because it looks like the key is leaking or something. But so we rush to reproduce a very small contract. So this just contains a core logic of the Terra breach of them how to verify these signatures. Besides that, you also need to getting the current state, getting the current working state from the contract. So for example, here we have to get all the valid signers, the nonce. So we started by validating all the transactions from the last working transaction, and then the first two failed ones. From the result, we can see that the signers are still the same. So in this case, we are more comfort that at least the signers are same, so there's no possible key leaks here. And we also try to fix replay the next transactions with the correct nonce. So all these signatures can pass this, the valid verification. So which means this is a quite small issue, because maybe the Terra Bridge backend they fail to synchronize the nonce between the Terra side and the Ethereum side, so which caused a series of failing transactions. And next thing is trying to figure out why the first transaction failed. So by digging down the underlying token contract, so we find out it's a B Ethereum contract token, and by looking at the code, we can see in the transfer function, there's an assertion that the receiver cannot be the token itself, and then we can look at the actual input of the first failing transaction. So this user is trying to like withdraw the tokens to the B Ethereum token itself. So actually this caused the failure and then block all the coming transactions. So this can be a random error, or it can be a target, someone carefully target. So it's disturbing, but at least it's not the end of work. So we inform the Terra team with our findings, and we are very good to learn that they're responding very fast. So it first reply in the Telegram chat, and then fix the issue very quickly in like 2 or 3 hours. So this with this thing happen, actually we have more confidence with the Terra projects. So this is just a typical example of our workflow. So besides our developing, we trying to like do a lot of analysis and try to reproduce all these recent hacks by digging down to the real cause. So this is how our team is working. Yeah. Thanks.
Thank you. Cool. So, but you don't know if it's a targeted attack or if it's.
Yeah, but actually, it could be like a denial of service attack. But actually, at least there's no risk of losing funds. So and at least the Terra team they're responding very fast. So at least we're knowing they are trying to fix, and in the last resort they can also stop the breach temporarily. So it's just a matter of time for them to fix the issue. So that's how it's happening. Yeah.
Now it's not working at the moment, the bridge.
Oh yeah, it's working now. It's working now.
Ah, okay, they fixed it.
Quickly resumed after like 2 or 3 hours.
Okay. Okay. But you don't trade on this event. You don't try to trade, or?
We got a lot of user response from the Telegram chat. I got the notification from my colleague, so he's asking like why he's failing to transfer the funds. Yeah.
Okay, but you know, such event you can also like look at such event and think about if it has like.
Yeah, we used to do arbitraging between like Terra and Ethereum. So, but
okay.
like a few months ago. Yeah.
Okay. No, I mean the other way around. You know, I guess there are people around there looking at these errors,
yeah, of course,
and then they think, oh, this maybe could be an event to trade, to short it, because it will blow up and then the price will fall. So you have some kind of information.
We also check on Twitter that this thing didn't stir up. So it looks like it's not a on purpose attack. It's not it might not be an attack on purpose. Yeah.
Yes. Okay. But you yourself could trade it.
Yeah. Yes, it's a little next level play.
Yeah, of course. Yeah. No, I don't know. I guess maybe there are people around there especially look for this kind of events and then try to. They see it first and they go in a short position, and then if it blows up, they make a ton of money.
I agree. It's actually it's a quite good trading chance.
Yeah. But it's very different. Your reaction on these events are somehow, you know. For myself, it depends very much on the mood, you know, of the market. Sometimes if the market is shaky anyway, and people think, yeah, it's not so, prices are like maybe falling a bit off, and then something happened, and then sometimes there are big like downfalls of price. And sometimes if it's more bullish, that's my experience, then like everything can happen. Nobody's going to be disturbed, you know.
Yeah. Yeah.
It's
great.
very strange on the sentiment of the market plays into this. Yeah. Okay. Yeah. Other questions? So yeah, I skipped Mindao out as I skipped him, not on purpose. It was just happening. So I guess you can go next, please. Yeah. Thank you.
Okay, sure. Let me share the screen. Yeah.
Yes, please.
Can you see that?
Yes.
Okay. Yeah. Hi guys. This is Mindao from DeForce. We actually are DeFi protocol working on lending, stablecoins, as well as synthetic assets. And this project, we're looking at full disclosure. We are one of the investors in the project. This is a lending market for liquid staking token. So actually, we look at the overall lending markets. I think that the fundamental block still being the lending protocol. We look at the top three and a general lending protocol. But I think the problem is that they actually are not really addressing the market for liquid staking token, which is a huge market. It's about 1.2 trillion US dollar. Except Bitcoin, I think all the public blockchains is going to be in POS one way or another. So this is a huge market, and I believe it's also a sustainable infrastructure. And also there was abundance of liquid staking assets around, including what we know, the Lido is already issued a ETH 2.0 staking token. They have about $5 billion staking asset there, and there's no lending market support for that. So I think that the lending market for liquid staking token, the fundamental idea is about converting the staking yield into saving yield. In a sense, it's creating a money market for liquid staking tokens. So we see that already Lido and Staffy and the other projects already issue a lot of these yield tokens, and mainly they just stake in the curve pool for liquidity provision, but there is no market support for lending. And when we actually went through this, I think that our revenue model and market cap is basically, for lending protocol, I think that the fee, they charge a fee on this interest rate spread. So I think the addressable market cap for this liquid staking token lending market is definitely $100 billion US dollar. Eventually, we just use that to actually benchmark against the DeFi lending market at a stage, because this is a much more sizable market. But I think that the major lending protocol is quite difficult to deal with this kind of asset, because one is that it's different structure, different risk reward profiles. And when we look at this one, we also check the team. They're very experienced in POS staking businesses. And on the security side, they use actually default smart contracts. So I think that it's already better tested. And I want to go into the underlying model. So we look at the lending protocol. It's quite important to actually understand where the yields are coming from, right? Is it a sustainable yield, or is actually some form of subsidies from the governance token? So for example, for a people who actually hold a staking token, what they can do is they stake into the platform and then lock up the liquidity to secure the security of the networks. In return, they'll have a staking yields. But the problem for all these staking tokens is that they typically have like 1 week to 3 weeks unbonding period. So during this unbonding period, there will be no yields and no liquidity. And it's very difficult for you to unbond it. But actually, like Lido and Staffy, what they do is actually that they create a wrap token on top of these staking tokens. It's similar to actually wrap it like a C token, right? So when you have the token, you have the staking yield of the underlying network. But the problem is that this kind of yield token actually, you have to have a liquidity. Either you unbond it or you actually trade it in the curve kind of pool. So I think the fundamental logic here is that you look at the analysis we have done. On the first column, actually the staking yield. I use our Atom as an example. So basically, the 8% staking yield. The second column is actually the borrowing cost for the underlying token. So you can use the staking yield token, borrow the underlying tokens. For example, you actually can borrow at 6%. The spread is 2%, right? So an LTV of 65%, you can actually leverage up your staking yield to 13, 14%. So it's almost 70% improvement on that. And I think the beauty of this leverage is that it's more like it's very similar to stablecoin leverage. So basically, there's very little risk of margin calls, right? So you won't be able to, you will not run into margin call because the yield token and the underlying token, the same kind of token, they follow same kind of market price movement. So we also run some sensitive analysis on the LTVs plus the spread between staking yield and borrowing costs. So as you can see, as you run the LTV higher, for example, like for R or ST ETH, the leverage staking yield definitely going to be higher. So here is the live market. So what they are onboarding now is R token. It's basically a yield token from Staffy network. Staffy is running it's similar to Lido, but what they're doing different is that they do it in a more decentralized way. So the RETH, RAtom, and RDOT are actually staking token for ETH 2.0 for Atom networks and also Polkadot. So you can see the staking yield here is 6%, 7%, 11%. These are the underlying yield. So for a depositor where you hold this token, put it into this market for collateral, you naturally earn these staking yields in the background, right? And the farming yield is a governor's token incentive yield. We just look at the staking yield. So basically, if you actually use that, and then you can borrow the underlying tokens, you can see you can borrow ETH, Atom, DOT, etc. It actually push up the yield for all these assets. So I think what is interesting is that it's going to be create a higher yield market for the underlying asset like ETH, Atom, and DOT, which you actually look at the general lending protocols supporting these assets. They typically very low yield, right? It's almost close to zero. The reason is that they don't have a good way to find a yield. So I think for lending protocols specific for a staking yield token, it's making it possible for you to actually convert the staking yield at least partially into like ETH, underlying use for ETH, Atom, and DOT. So I think this is going to be a very interesting sort of market that you can create a yield market for some of the mainstream crypto assets, particularly for some of the POS assets. And this is something that I think the general lending protocol is very difficult to do. One is if actually they're onboarding these assets, it will be quite a disruption to the risk models where they're running now. And the second thing is, I think it's quite difficult to actually accommodate this kind of model with a general lending pool. So I think for this, I think they definitely have a very good product market fit. So that's my presentation. Yeah.
Yeah, thank you. And is it running on Binance Chain or I did see?
Yeah. It's currently run on both Binance Smart Chain as well as Ethereum mainnet. But I think for Ethereum mainnet, the problem is that there are not as many underlying tokens on Ethereum, right? So for example, you cannot find DOT, you cannot find Atom there. Yes. It will be some limitation. But I think Binance Smart Chain is perfect because they have all the underlying tokens there, so you can re-leverage it. So typically for like Atom, you can re-leverage like 3 or 4, 2 or 3 times, and potentially just increasing the yield. Yeah.
But you have to leverage them yourself. They don't have a tool. The thing is, way back, you can leverage by yourself by taking it out and then provide again. But then
exactly,
but there's no tool to do it for you.
Yeah, I think it's quite similar to LP token leverage, right? So first that you have an LP token in the lending pools, then you do it yourself, and then Alpha Finance coming out, the Alpaca coming out to help you to provide the tools that you can do, one-click leverage. I think that's something that can build out on this kind of protocol. It's very simple. I think you can leverage it in a very straightforward way. But I think for this U token is a little bit, it won't be like one click, because minting the R token itself could take several steps, right? You need to go through different networks. So it won't be a one click, but definitely can be a solution. It's very straightforward for you to just, send a command, and then it help you to actually re-leverage like 3x. Yeah.
Okay, cool.
So I think what is interesting is hopefully the Lido's ST-ETH is a very big asset. It's $5 billion US. I think they're actually, if actually they can add, Lido's ST-ETH, I think it could be a very interesting sort of interest rate market for ETH, right? So it will be something that maybe the base rate will be increasing for 0.5% to more than 2.5%. I think that would be quite interesting dynamics where if you actually don't want to stake ETH, you can provide to the lending market for earn some of the yields, and then you still have the instant liquidity if you actually want to withdraw from the lending protocol. Yeah.
Yeah, thank you. Yeah, I think it will be a huge market. Yeah, that's definitely true, because it's just the basic. If you also look at the basic, I try to in Switzerland. There's like a Bitcoin Swiss, how they call it, like a crypto bank, or they try to be. And then I own some DOT, and then I would like to be a customer with them, but
yeah.
I can't, because it's just they ask me I should provide the banking statement which I paid for the dots. I don't have a banking statement. It's money from I put over different exchange, and then in the end I bought some dots, one of the markets. I can't be a customer for them somehow, because they live in the old world, and so I guess I can't go outside of crypto like in a traditional bank. They're not traditional, they're really a crypto bank, but even they can't have I can't be their customer somehow, because it's too complicated.
Yeah. So I think that's why it's quite important. I think some of the candidates here also present a lot of cases regarding fixed incomes, etc. Right? So fixed income is definitely the fundamental layer in all DeFi. Yeah. So once we have that layer, we don't actually need to go out from crypto, right? We just because all the opportunity costs within crypto, stablecoin, BTC, ETH, and the other POS tokens can find the banks within the DeFi sort of realm, right?
Yes. Yeah, also, you have to provide.
They don't need to go out to seek use from the traditional CeFi or some of the other traditional ways. Yeah, it's totally like self-sovereign on that sense.
Yes, yeah, and also the Bitcoin Swiss, you need dots in the value of $100,000 to be their customer. Otherwise you can't be their customer, and not a lot of people have this kind of money in DeFi. We maybe, but retail has not, and they should also have access to these protocols.
So I agree with some of the candidates here today is that, we definitely have a lot of opportunities on the DeFi verticals, particularly on the lending side, like, tranche facilities, fixed income facilities, and liquid staking, lending market, etc. We definitely have a lot of these opportunities on these layers. And I'm confident that there's a lot of protocols coming out from this kind of, vertical.
Yeah.
Okay,
thank you.
Thank you. Yeah.
Other questions? Someone else? Okay, so who is next? Now I have to see who's on the call. On the time shell is JX. Are you here?
I can be the next.
Joined. Cool. Thank you for joining.
Sure. I miscalculated the time, so I thought it was tomorrow morning. Okay.
This happens sometime, It's just Mindao, I think you have to unshare your.
Yeah, I think maybe after Mr. Mindao can exit and I can share it.
There's a button on the top where you can unshare it on the.
Is that okay now? I already.
No.
I just.
Oh, let me. Okay. Good now?
Oh,
Yeah.
Thanks.
Oh, sorry, wait one moment. I need to open the privacy settings. Can you see my screen? No.
Not yet. I don't see it. Yeah, now.
So should work
Oh.
right now, right? Okay,
Yeah.
I think I'll show an NFT or GameFi projects instead of what DeFi. I think a few people have mentioned before. So I've been working on the Axie token model for a while, and some of you may have read the report. So in the report, I analyzed the eco flywheel of the Axie Infinity, which mainly like divided two parts. One is the battling part, and the other one is breeding part. So what I didn't like cover is the land ecosystem. So the land ecosystem is the sum of the Axie Infinity will launch like I think it was supposed to be Q3 or maybe Q4. They have already released the alpha internal test version, and I think they will release very soon. So I think first I will give a high-level overview of what is the land ecosystem in Axie Infinity, and why I think it be undervalued. So first of all, the types of Axie lands or NFTs similar to Axie Sandbox and also CryptoVoxel or Mana. The total amount it's like square for 301 multiplied 301, and it's about a little bit above 90,000, and it's called Luna Landing. There are four types of like infrastructure. One is the landing, and most lands can be divided into different rarities, like according to their distance from the center, and like the most rarable one, the most rarity one is Mystic one, and also the Genesis lands, and also called Luna's Landing in the center of the map. So the center of the land called Luna's Landing is owned by the Luna Council and used to incentivize content creators. I think right now most of the Luna's Landing is owned by the team and by the Axie Infinity team itself. And the pink squares are called resources or chimeral. I think the pink lands will provide many interesting stuff like spawn locations and play a role in hosting dungeons. I think these are very essential to create new game scenarios. So lands around the pink ones, we have the first priority to participate in the new game. So I think the most lands near the pink ones are called Mystic. They are also very expensive lands, and the simple lands are like the Arctic lands, forest lands, and the savanna lands. So the more and beside the lands, there are also roads and river. The blue ones are river, and I think the lands are linked with the roads. So if you travel on the roads, the roads will speed up you by 300%, and also a chest can be used up to 100 of a certain land type, and it's kind of like an item on the land. You can buy it to enhance the compatibility of your land. So the gameplay of the lands are I think they are drafting at a very preliminary one, but they can be upgraded in future gameplays. Basically, the land holders can upgrade and customize their territory. So you can earning from the land. You can play to earn. You can battling and breeding on the land. You can get more resources if you have a closer to the road or close to the river, or you have a very special items on the land. So PvP and PvE battling systems still available on the gameplay. So how to buy the lands? I think it is we can evaluate from several factors. One is the rarity. The more rarable the land is, the more expensive. Like also like the Genesis lands is more expensive and more rarable than the Mystic one and then the Arctic and Forest and Savannah, and the more close to the central location, the more I think the more potential elevation of the value will be accrued, and also the roadside and the riverside. That's something we guess from the community and the testnet, but it's likely to be taken by the in the real gameplay. But maybe it's not 300, maybe it's 200 or 400. And also adjacent to connect the point is those very important price principle. If you buy one land in the north and one land in the south, you can buy two lands together and connect them in as one land. So this will expand, and maybe you can get like 150 bonus if you have two lands together. Okay, I think many guild like YGG already bought like a few lands in every area. I think they have more than 200 land. Yeah, right now it's open for in among the 90,000 lands. I think not every land are available. There are only like I think only right now less than 1,000 are available. So the resources are very scarce. And the price right the price are I made the chart in August. So right now we can see the price has been dropped a bit, because I think today because the market sentiment is low, and also because the August market sentiment is pretty high for the Axie Infinity, and it goes down a little bit. I'll analyze the price factor in later stage. Okay. And there are a few items on the lands to be chosen, and each one represent a different tactics. And I will not break down into details, but maybe I can provide some of the website to check for you guys to check later. So let's see why it's I think it's undervalued. First of all, we can see the important price support of the game is the growth data. The more the simple logic I have put in the Axie economic system is that the key takeaway is more people are coming to the ecosystem. The growth likely, the more like the ecosystem would likely to thrive. So we can see from the since like the July, the growth rate is above like 30 something, 40 something percentage, and then it slows down a little bit in August to single digits. And right now in the first week of September, it goes back to the like the double digits growth rate. But at the same time, the land price dropped. So people didn't realize how to like play on the lands, and they don't know how to evaluate the lands. So many weekends has already liquidated some land. So I think that's a great opportunity. And I didn't do the exact math. If we compare the total market cap of lands, and also if we compare the growth rate of the total market cap of lands, and also the Axie, the AXS growth rate, we can see the lands are like almost 1 to 3 times as June. But if we open marketplace, we can do it right now. Yeah. Yeah, we can see the price is comparing to June, it's like 20 or 30 times, almost 20 times. So the lands only get the price gets increased by 2 or 3 times, whereas the market price get like 20 times multiple. So I think there are still multiple growth rate for the lands.
Okay.
Personally, yeah, but there are still very uncertainties. just some, I think, some personal bets. Yeah, that's that's my sharing. Yeah, welcome.
Cool.
Feel free to any questions. Yeah.
I never used it, so I don't have a clue about this.
Okay.
But they are non-fungible. They have their own chain, or how is it technically? They have their own
Their
chain.
own side chain. Yeah, Ronnie chain. It's just a side chain of the Ethereum.
Okay, but it's their own. Only there's not an open chain. Only their stuff.
Not open chain. Yeah, they only support their own games. Yeah.
Okay.
Guaranteed.
And they have other games. They have other games too on the same
nope.
chain.
No,
Oh,
right now it's only Infinity, and also I think the server is is overload. We can see the growth rate of the August has dropped single digit, right? That is not because the game is not popular. That is because the server is down for several times during the August. There's too much people coming in. Yeah.
Okay.
You see the monthly volume, the monthly like the DAU is above 1 million. It's I think the history breaking record of the blockchain crypto games. Yeah.
Okay. So they do, how many transactions do they do a day?
Let me see. I don't, yeah, I can see on the Ronnie Explorer. Let me see.
The interface is similar to other chains. You use.
The interface is similar as Etherscan. Let me see.
Okay.
They have total 53 million transactions. Yeah. Total transactions for 53 million. So the transaction is not so frequent, I think, but most like the server interaction is off chain. The server is very loaded. Yeah.
But the land is not the land. You can't game on the land. It's just the game. It's just will be roll out in the future.
Yeah, it hasn't rolled out yet, so it's undervalued. Yeah, people haven't know yet. Very few people know its value. Yeah.
Okay.
Yeah, that's all from my side.
Let me see. Yeah, thank you. I know somebody else have questions. Now it's only me asking stuff. Yeah, I think then maybe we move on. I think that's okay. We're on time. We have like 20 more minutes to finish this, and we have 2 more people. There's like I know Brian. Are you ready or Xminion? 0xMinion? You both are. Yeah.
Yeah, I can
Brian.
go. I think 0xMinion is not here yet. Not sure.
Yeah, I'm here. I just need help with screen share. So, because I'm on my phone right now.
Okay, yeah, go ahead.
Do you want to go first or I go?
Confusion.
Yeah, I can go first.
Okay.
So sorry, I don't have a slide, but I'll just
that's okay.
Send it. So so the project that I want to talk about is Lido, which is kind of similar to the project that was mentioned here before on liquid staking. So very often, like when we choose what to invest, we try to predict what where the market's going, what sort of narrative it's forming in the future. So I think back in April or May, we sort of think about, what's the impact for EIP 1559 and what's going to happen for ETH2 upgrades. So, and turns out the upgrade was, almost as big as like Bitcoin halving, right? So we try to see, what sort of bets that we can do around this area. And a disclaimer, we are an investor in Lido. So we think that, with ETH becoming a better quality assets, less inflationary and then eventually deflationary, and becomes a proof of stake. I think people are becoming more bullish on ETH, and with that, people want to sort of like utilize their ETH in an efficient way. So we're quite bullish on liquid staking. So we try to look into this area, and we see that Lido back then was the top it has the highest market share on liquid staking. Decentralized, highest market share for decentralized solutions. So I think the highest one back then was like Kraken, staking on Kraken, but they don't have like the wrap tokens, right? So I think right now they might be higher than Kraken. I'm not too sure, but right now they are probably I think 85% of decentralized liquid staking market share, and probably like 20% of all E2 staking market share. So yeah, the project is pretty simple. It's nothing too technical, it's nothing too complicated. It's basically just you stake your ETH on the beacon chain, and then you get a wrap token for called STETH, and then you can use that STETH for all kinds of stuff, for yield farming, for trading, or whatnot. I think we're quite like Lido, because we think that the liquid staking market is something that's like winner takes all. So you know, if Lido is the one that, you know, sort of take all the market share, we'll just continue taking all the market share, given that, you know, the more DeFi project, more exchange will support their liquid staking tokens. So I think it's just going to snowball from here. So that's why we really liked the project back then. It was quite an easy, simple decision. And we also quite like the fact that, you know, their model is quite simple. So I think they take 10% of the staking reward, and it goes to, and half of them, and then it goes to the DAO. And then you know, and the DAO, they have the ability to you know, build the product, build the community, do BD, and also provide insurance if anything happens. And you know, in the future, the DAO might be able to even vote for some sort of like value accrual, some revenue fees go back to the Lido tokens, but that's not implemented yet. Could see that in the future. So yeah, we think the narrative here is really strong. And also they will be launching, you know, ST Sol. I think that's the next one, the pipeline. They already have works with Luna as well. They'll probably like integrate other all POS chains. And with ETH2 coming, I think that just opens up like billions of dollars, like multi-billion dollars of TVL goes to Lido. And I think you know, the token can really be seen as a sort of like layer one index or like a governance layer for a lot of POS chains. And you know, that can be a fraction of combination of all POS chain that's, you know, staked on Lido. And I think that's a very, very powerful you know, powerful narrative for this market. And I think moving forward, like I personally really want to see like FTX. I've been trying to, you know, get FTX to support like STETH, ST Sol as well. It's just like, especially as a collateral, that'll be like super good, because you know, you can get the first thing, like you don't have to worry about the you know, staking on Solana. You have to there's like 7 days withdrawal period and ETH as well. So I think you know, you can have that liquid staking token, you know, trade, you can use on FTX as collateral, and you can start trading with that. You know, I think that's very, very interesting. So yeah, I think this is a very, very long-term project for us, long-term investment. So yeah.
I was surprised that you know, I ICO'd like Rocket Pool.
Yeah.
And Rocket Pool, it never took off. I don't know why, you know, it just, it was like 3 years ago, or even they have like and they wanted to do all distributed, but maybe their product is just too complex. I didn't check. I don't know what they are doing right now, but somehow it's like an investor of the competing earlier project. You think, you know, it's like the new kid on the block, and it was relatively fast. They have grown to they took the market share quite fast, you know. Yeah. But somehow, as you said, you know, maybe they have just the more simple product, because the Rocket Pool should be like like some decentralized infrastructure who then is running like everything, you know. And I guess I don't know Lido so much, but I think somehow it's like with the multi-signature. How is the security? It's not decentralized, I guess.
At the moment, it's not. It's basically just a DAO with like, you know, I think like 11 people holding the keys.
Okay.
We saw a lot of others like liquid staking projects, but I think like, you know, no matter like how good their product is, like Lido has the, you know, sort of like the advantage in market share. It's quite a simple product, so it's quite easy.
Yeah, but somehow you see this decentralization is can also very hold you back in your design of your software somehow.
Yeah.
Myself, I have like some of the next, or I think decentralized infrastructure will be maybe very common in the future, but I don't know the time scale, just because it's very hard it's not easy to do, you had a lot of problems. We see it with like Rocket Pool. And I sold too early, like every time.
100%.
Yeah. Other questions? Mindao, you are in a similar.
Yeah. Hi, Brian. I have a question regarding Lido because we're actually looking a lot at these liquid staking issues. I think the problem is actually, if you actually look at the POS landscapes, right? People are very wary about centralization in terms of the validators, right? For example, people are really totally against Binance because they naturally have a lot of monopoly on the POS staking business. You look at like Cosmos, Polkadot, and all these other POS chains. Binance naturally become a top validators and sometimes have a veto right in terms of the consensus. So I think for Lido, what is the upper bound of the market it can actually get within a network? For example, if actually it controls, well, I look at Lido as a liquid staking aggregator, right? It's similar to a YFI in terms of liquidity mining. But the problem with an aggregator in a POS network is that it actually creates a centralization risk. Single point of failures, right? So for example, if the operation on the Lido side have any failures, I think there will be a huge impact or security risk for the Ethereum network. So I don't, that's why I think for validators, naturally their market share is not going to be go like exponentially or predominantly within a network. Probably will be capped at a certain level. And that naturally will actually cap their potential. To be able to have a unlimited sort of potential within the networks. I don't know how you guys look at this, the limitation of a validator network within a POS network, because I think it definitely creates a lot of security risk from a consensus perspective.
Yeah. So you're saying like there's like, let's say like too many, like Lido taking too many market share, and they just have too much power over like
exactly.
POS.
Yeah, I think they already have more than half of the staking of each 2.0 staking market shares.
Yep. I see. I guess I see your concern too, but I think so far their DAO has been working like quiet, like in a decentralized manner. I do see like they implement some change in that front in the future, but yeah, I'm actually like, I actually don't have a perfect answer for this as well. I think like Constantine probably like would consider that if they grew too big for all the chains that they work with.
Yeah, I guess this is really a topic. We will see how this plays out, at the end, because it's difficult. Myself, I'm also more on the decentralized side, and I somehow I think it's strange that then a big entity has this kind of market share of these proof of stake chains, because at the end, I think you need 2/3 to. You can attack maybe. It's not on you don't have it makes no sense to attack your own network somehow, but it's somehow maybe it's if you see the fights now or some fights with the miners somehow, we had some resistance to the lately change of the gas burning, and then so maybe they also have they build like so much power they just can resist certain developments in the future maybe. But yeah, nobody knows how this is playing out. We will see. Yeah, thank you. So we have the last one is Minion. It's a French. I don't know. Is it French? No, I don't know.
Hey.
Go ahead. Hi.
Hey. Yeah, Martin, I'll probably need your help in terms of screen share because I'm on my mobile phone at the moment. So if you can go to Pendle.finance, PENDLE.finance.
Yeah.
And share that screen. That'd be great.
Just a moment here. Yeah, I have the site. share it.
Yeah, so in the meantime, I'll probably introduce, I guess, like Pendle Finance, really. So the reason why I sort of start looking into Pendle Finance just basically on the tokenized risk protocol aspect. So right now in DeFi's industry, we only have variable interest rate. But in the traditional space, we have fixed and also variable or slash floating, right? So Pendle Finance does a lot of interesting stuff as well, and I guess that there are a lot of other protocol out there doing similar things. So I think Chris in the very beginning shared Element Finance as well. But they target at a very different, I guess, like user base or I guess the product market fit. So what Pendle Finance does is that essentially it tokenized the it sort of separate two things. So normally you have, say, for example, if you deposit, say, $1,000 to Compound or Aave, you will get a C token or A token respectively in return as a sort of bookkeeping token. So what Pendle does is that essentially separating the principal token and also the yield token into one called ownership token and ownership token, OT token, and yield token as YT token. So essentially creating that sort of, I guess, DeFi Legos in natures, enabling the sort of, I guess, the DeFi sort of playbook in the futures for these DeFi protocols to integrate. So take an example, right? So if you can go to so Pendle's main page and then go to dashboard. So I'll go straight. I guess looking at the yield at the moment. So if you can, Martin, if you can go to the main page.
The thing is, I don't have a wallet on this computer.
Oh,
so it's not connecting.
I think you.
This is a bad design, you know. I don't like this kind of pages.
Yeah. So what I'm looking at is that looking at the yield at the moment. So pretty much in terms
but I can check it on the other. I can check it. I have a second computer on my side.
No, it's okay. Yeah. So if you have the dashboard over there, and then essentially looking around, I guess the yield. So the OTYT Pendle to Ethereum pool 2, essentially it's a pool 2. Yield is at roughly around 500% per year, simple interest. So in the very beginning, it started with around 2,000 or 3,000%. Right now, is maintaining at roughly around 500% APY. So though the sector is still early, so in the very beginning, I thought about it in terms of whether we really need fixed and floating interest rate kind of like protocol. But I think the main sort of target user is not, I guess, like retail users or everyday sort of DeFi farmers, but it's more around the protocol on the backend protocol integrations. So say, for example, what if SushiSwap or Uniswap integrates something like Pendle Finance to offer a fixed yield trading fixed yield LP positions on SushiSwap UI straight away, rather than going through Pendle.finance or other alternative protocols, or even something like, say, for example, leveraging Pendle Finance AMM as the price oracle for interest rate sectors. So we have the Uniswap AMM as the sort of a pseudo price oracle. So though the industry is still mainly using Chainlink, but Uniswap v3's release and also the layer 2 release, making sort of Uniswap v3 AMM usable in terms of some very special use cases on the price oracle. So similar logic can be applied towards Pendle.finance as well, though it's still in the early stage. So I still call it bootstrapping phase at the moment. So So they've got their special design of AMM, looking to tackle the sort of time value of money in terms of depreciation. So they've got the time sort of time depreciating AMM, so called, which essentially reducing the I guess trying to eliminating the impairment loss caused by the time value of money. So that's that. And currently, I guess the Pendle.finance pool 2 yield is around roughly 500%. So
yeah, it's 500 and 500, 600 almost.
Yeah, somewhere there. So they started over just a little bit over, I guess, roughly 3 weeks ago. They just kicked off their liquidity mining, I guess, like pool 2 liquidity mining incentive program. Before that, they were doing over, I guess, they were incentivizing Compound and also Aave Vote in terms of incentivizing people to tokenize that fixed and floating interest rate token. So this one at the moment, circulating market cap is around 40 mil, and fully diluted is around 150 to 180 mil. So it's still very early, and mainly, as I mentioned before, I mainly cover small to medium cap. So just to find the early day farms and also early projects, and then I guess like accumulating these tokens potentially, or I guess like looking around different farming strategy potentially, and also a lot of doing a lot of other things as well. So I guess that's that sort of a bit of a sort of nuts and bolts about Pendle Finance.
Do you have connection to them, or is it just you're farming at the moment? Or?
Yeah, so just disclaimer, I'm also farming on Pendle Finance pool 2 specifically.
Yeah, but you're not you're in the community, or you're just a customer.
So me personally, I found out Pendle Finance, previously called Benchmark. So last year, roughly, I can't remember, October, September, October. Yeah. So they were called Benchmark back in the days. And then later on down the track, they rebranded towards Pendle.finance.
Yeah, I heard the name, but I never had time to look at the project. I didn't know that they have started just farming.
Yeah, so they just kicked off their liquidity incentive program roughly about 3 weeks ago.
And how long does it run?
So pretty much it's run, I can't really remember off the top of my head, but like, so at the moment it's measured by epoch. So right now it's on the third epoch. No, I can't really remember off the top of my head. They've written somewhere in their Medium article.
Okay.
Yep.
Yeah, of course. I think it's very interesting. Yeah, it's an interesting idea, to split the token somehow. And it's strange that, in a way, I guess also like Core, Aave could do it for their own stuff, but they don't do it somehow. Strange.
Yeah, so it's very different propositions. So I've seen quite a bit of a, I guess like tokenized risk protocol design. So if you've got like risk trenchings, say for example ADA and PH or Saffron Finance, and you've got other sort of protocol doing like game theory type of thing, and also order book. So I think why I like Pendle Finance specifically. So I guess I have several reasons, right? So first of all, it's one of the first to release their product, as in the sort of splitting token into principal token and the yield token sectors. So they're one of the first to release the product. So I guess like second one is obviously Element Finance, right? And that's my first reason. And second reason is that I guess in terms of the I guess like the overall market cap, or looking at circulating specifically, it's still relatively low. So I would actually see more I guess like more upside than downside looking at circulating market cap at the moment.
Yeah.
And thirdly, in terms of the actual actual mechanism design, so I'm actually very sort of like I'm more I like the design in terms of splitting the actual token into principal token or yield token. So simply because it enables the actual DeFi legal to play around with these designs. So if you don't really split, say for example, if you're only making like an interest rate exchange, then you can't really have the DeFi composability part into that as well. So and also I guess last reason is that it's an AMM design. So I guess for me, I've looked at a lot of other designs, say for example, order book as well. Order book does have, I guess, like specific advantage, say for example, capital efficiency, and also I guess like a market maker can actually step into it, right? So, but the major concern is that it like for other type of derivative or perpetual future, say for example, we know how to price it. It's just basically got listed on centralized exchanges. People in the industries know how to price these things. But generally speaking, I don't think we know how to price, say, for example, compound yield or Aave yield or even SushiSwap LP token yield in a way that market maker can actively market make these liquidities. And also, I guess, like on the order book side of things, it's more around you need to invite market makers to step into the game and pulling in and also pulling out the orders. On Ethereum specifically, it's very expensive. Even on layer 2, it's still not that ideal. Yeah. So I think the AMM design in terms of on the Pendle finance or other sort of similar tokenized risk protocol sectors, I think that it's the right way to go, just because first of all, we don't really know how to price it. Secondly, bootstrapping liquidity is much more important in the very, very early stage rather than capital efficiency. We can upgrade that later on down the track if you want. So it's like Uniswap V1, V2, V3.
Yes,
so V2 is more on
yeah.
the liquidity bootstrapping, but V3 is more on the capital efficiency side of things.
Yes.
So I think that's the sort of right way to go. So overall, I personally like Pendle.finance, and also the yield is at 500%. So why not?
Okay. Yeah, I think that's it from the call, I guess. Yeah, you have been the last one.
Perfect. Thank you very much.
And yeah, we did see a range of different projects and different people presenting, and I think it has been nice. One of the goals of this call is also that that we, as a member of the Boule, maybe future member of the Boule, if we are like voted in, that we have like some connection. Because if you look at DAOs or community, DAO somehow are community driven, and this is a try to that people know each other a little bit better, and then I think it's easier to contribute and to discuss things. Also, maybe if it's it's easier to discuss things if you discuss like on a neutral ground, and we will see how the AladdinDAO is evolving. But I guess it's quite important that in the design of the DAO, the Boule members should just vote somehow every month, I think 4 times. But I guess it's important that we also have to be like the seed for a broader community, I guess, because it's not easy to build a community, and I hope that we are able to build a community. And I think if the Boule member can form some kind of community, then it's more easy to bootstrap the rest of the DAO. And yeah, I guess these are my final words. Maybe, Sharlyn, can you quick, there was one question of one of the yesterday in the call, so about the voting process.
Yeah,
maybe you
sure.
can give this input now, and
Yeah.
is it how does it work?
Yeah. So just quickly, so we actually made the voting rules public a while ago. So basically, the two ways to be elected as the Boule members. So either you get voted on top 30 out of I think we have 40 plus candidates. So people got voted in top 30 will be a Boule member for sure. Alternatively, anybody got voting power over 10% of Aladdin token circulating supply will be Boule member as well. And the reason we set the second rule is because everyone has been strictly selected, or I think everyone here is only overqualified to be Boule member, and if the community love them, right, and they should be elected as Boule member as well. So just meet one of the two rules and you'll make it. So we will publish the article on how things will run from this point forward. And just briefly, so liquidity mining will start this Friday. So I think the community will basically, the first month is just to spread the token among the community. So for community members can get the token and vote for the Boule members they like. So I think the voting is likely to happen on 24th of September. So basically, we're 2 weeks into liquidity mining, and there's, meaningful token spread around in the community that people can get a hold of, sufficient tokens and then make a vote. So that's, how things are going to work. So once the Boule is in place, then we'll start working on asset selections. Yeah, just add briefly on, the meeting today. I'm just so impressed. Just learned so much.
It worked well.
Yeah, learned so much from everybody. And I feel strongly that AladdinDAO is a community for researchers and the learners. And I'm just very proud and honored to have this opportunity to work with everybody. And also, thank you so much for Martin for being such a great host.
Thank you.
I've done a great, amount of work to get this organized.
You're welcome.
Thank you.
But I have a question about the voting. Now I'm a question hosting would. But is it voted on chain? The vote is on chain.
So the voting going to happen on Snapshot.
Okay, cool. Yeah, because then everyone can take part. And so it's just the candidates are listed, and then the 30 people who get the most token allocated, they are in and other not.
Correct. So we're preparing that proposal. So that'll be a big proposal. We list out all the candidates with 40 plus people, right? And so basically, all the token holders can vote for, everybody they like, right? They can vote for as many people as they like of the list.
Or they just distribute the token, to the people somehow.
Yes.
Cool. Thank you.
Okay.
Yeah, thank you for organizing the technical part, the streaming and all this kind of stuff, because I didn't do it. You managed this, and
you guys
so
have
tomorrow to close this tomorrow is the next call is at the same time, not hosted by me, but it's hosted by it's for the Chinese community mostly, I guess. Is it in Chinese or most? Or?
It will be in English. So it will be hosted by Eraser Lee at the same time tomorrow. And I think we'll have 10 members as well. I think a number of them are non-Chinese, non-English speakers. I think we'll have 3 or 4. So we will arrange translation for them.
Oh, cool. Yeah. And then they're
Thursday and Friday as well. So we'll have this the entire week for research.
Yeah. Cool. So looking forward to the other calls.
Okay.
So have a nice evening, everyone, and thank you for joining. And see you tomorrow, I guess. Some of you.
Yes. I'll be here for the whole week.
Okay. Yeah. You too. Yeah, me too.
Okay.
Ciao.
Thank you, everybody.
Cheers. Bye.
Thanks, guys.
Bye.
Perfect. Thank you.
Thank you.
Thank you.
Cheers.
Bye.